With Americans facing a historic amount of debt, credit scores could be taking a hit, and that can have a big effect from buying a home to the amount that you pay for your internet or interest rates. Joining us this afternoon with how you can improve that number is our financial expert, Paul Hood with Hood CPAs. Paul, always good seeing you.
Good to see you.
So let's start here. How can you find out your credit score?
Well, you know, there's 3 credit reporting agencies, and you can check that. Your bank can do it for you. Go and try to buy a car, you know, or they'll run your credit. Credit scores are a strange apple, though, because if you don't have any credit and you pay cash for everything, then the banking institutions don't know whether you're a good risk or a bad risk. You would think paying cash for everything would want them to lend you money.
You would think.
You would think, but they don't. And so there's this happy sweet spot in there to where you've got to have some credit, you got to pay your payments on time, and then that builds credit, your credit score, so then you can buy other stuff. Mm-hmm. You can go too far and have too much debt or credit card debt or whatever, and then your credit score starts going back down. It's just a strange thing.
It is. Well, and the different things that can really hit and impact your credit score, there's a wide range of it. I mean, of course, do you pay your bills on time? Yep. How much of your bill are you paying? Paying off your debt does impact your credit score in a good way.
Yeah. It can be. Short term, it affects it very well. Yeah. Long term, being out of debt is bad for your credit score. It's a strange deal. So what I teach people to is if you can live for a while without credit cards, then bring credit cards back in, but pay them off every month so that you can get the points, you can get the rewards, and you can get the credit bump by having the credit card, but you pay it off every month so that it doesn't affect you financially and put you overboard.
Well, and it could be a real slippery slope if you, oh yeah, I'm going to leave it just a little bit of a balance, but you don't want to do that, especially with credit card interest rates right now. They're in the 20s? Yep. And that can really take a negative hit to your credit score really fast. What are other ways do you tell your clients to raise their interest rate, or excuse me, your credit score? You want the credit score good.
Yeah, well, there's agencies that you can actually go and they'll do little things and gift you a little bump. The advice is really on which end of the scale are you. Do you have not much credit or low credit score because you don't have much credit? Then, you know, go buy, if you've got cash to pay for a car or cash to pay off on your credit cards, use the credit card, put the cash in an envelope, make your payment every month. A good way is to have your payments be withdrawn automatically out of your checking account so that you don't, oh, I forgot, it affects your credit score. On the other end, if you've got bad credit because you've got too much loans, then there's a process of going through of trying to manage that and pay it off. The first thing is you got to get a budget, you got to get things under control and be intentional with what money you have to spend.
With closing out any accounts, maybe you believe you've got too many credit cards, you want to cut back, is it a good thing to close out some accounts? Would that even impact your score?
Well, it can. You know, so if you consolidate, then a lot of times the credit reporting agency sees that as a positive because you paid something off. And it's based on balance, but it's also based on numbers. So it could have a positive impact, yes.
Okay, good insight. Paul, thank you so much.
Thank you.